All right, let's dive right in. Today, we're going to pull back the curtain on a single concept that explains one of the biggest puzzles in your financial life: the financial spread. It's kind of like the hidden engine that decides how money really moves. Let's get into it.
You know the feeling, right? We've all been there. You diligently put your money in a savings account and you get back, well, basically nothing. But the second you need to borrow money for a car or a house, that interest rate suddenly seems to be on another planet. So, what is going on behind the scenes? The answer to that huge, frustrating gap? It all comes down to this one really powerful idea. It's called the spread. And believe me, it's at the absolute heart of how banks and financial markets work. So, what is it really? Well, simply put, the spread is just the difference between two related prices. Think of it as a margin. It's the gap between the interest rate the bank pays you to save and the rate it charges someone else to borrow, or the gap between a buying price and a selling price. Okay, so let's start with the place we all see this concept in action most often: our own bank. This is where the whole idea of the spread becomes crystal clear. Here it is. This is the basic banking playbook. The bank takes in your savings, your deposits, and pays you a pretty low interest rate for the privilege. Then it turns around and lends that same money out to borrowers at a much, much higher interest rate. And that big gap in the middle, you guessed it, that's the spread. It's really tempting to think that, isn't it? That the bank just scoops up that entire difference and calls it a day? But the real story is a little more complicated than that.
You see, that spread is actually doing a lot of heavy lifting. A huge chunk of it is set aside to cover a big risk: the chance that some borrowers just won't pay their loans back. It also has to pay for everything that makes the bank run. The staff, the buildings, the tech. And after all those costs and risks are covered, the slice that's left over? Yeah, that becomes the bank's profit. And this points to a really fundamental rule of finance. When things in the economy feel uncertain, or if there's a higher chance of people not being able to pay back their loans, what do banks do? They widen that spread to protect themselves. And the result? Borrowing gets more expensive for every single one of us. Now let's look at where else this idea pops up, because once you know what to look for, you're going to start seeing these spreads in all sorts of financial services you use every day. It's kind of everywhere. Okay, think about the last time you went on a trip and had to exchange money. You walk up to the currency exchange counter and you see one price to buy euros or pesos and a different, lower price to sell them back. Sound familiar? Exactly. That's another perfect example of a spread. The currency exchange service is building in a little margin for itself. It helps cover the risk that exchange rates could suddenly change, it pays for their kiosk and employees, and of course, it lets them make a profit. It's the very same principle, just in a different setting. All right, let's take this concept up a level. We're going to move from Main Street to Wall Street, into the fast-paced world of financial markets, where the spread is an absolutely vital sign for traders. In the stock market, you'll always hear traders talk about the bid-ask spread. The bid is the highest price a buyer out there is willing to pay for a stock right now. The ask is the lowest price a seller is willing to accept. So if you're selling a stock, you get the lower bid price. If you're buying, you have to pay the higher ask price. And the tiny difference between them, that's the spread. And what's fascinating is what the size of that spread tells us. It's like taking the market's pulse. A really tight, narrow spread means there are tons of buyers and sellers. The market is humming along and it's cheap to trade. But a wide spread? That suggests the opposite. Fewer traders, maybe some uncertainty, and it's going to cost you more to make a move. So we found the spread in our bank accounts, at the currency exchange, and on the stock market. But why does this one simple idea matter so much to the entire economy? Let's zoom out to the big picture. This quote here really hits the nail on the head. At its core, the spread is basically the price we all pay for having a financial system in the first place. A system that connects people who have money with people who need money. It's the cost of making the whole thing go. And this has a massive real-world impact. When spreads get really high, loans get expensive, and that can pump the brakes on business growth and consumer spending. But when spreads are low, credit is cheaper, and that tends to act like fuel for economic activity. And this is precisely why economists and regulators watch spreads like a hawk. They use it as a vital sign to check the health of the economy, to measure risk, and to see just how efficiently money is flowing from savers to borrowers. And that leaves us with one final, pretty big question to think about. If the spread is the necessary price we pay to make our whole financial system work, how do we know if that price is actually fair? How can we tell when it's covering legitimate risks and costs, and when it might just be too high? Something to chew on.